So I wanted to start with the steel and aluminum tariffs. So the real impact is going to be when it comes to pipelines. We source most of the pipeline steel material from outside the U.S. What's your view on what's that going to do to input costs?
On a very preliminary basis, because we really don't know how the details are going to work out, but we think that the impact on our project, which includes pipelines, which includes a liquefaction facility, and which include drilling wells in the United States for a long period of time, will increase our cost by 6 to 10%.
And where does that cost then fall in? Is that to you? Does it raise your cost basis for customers?
For us, yes, and then hopefully we can pass it on to customers, but there's no guarantee. So
And talk about passing it on. So one of the interesting things that Tellurian is doing is the way that you're marketing. So first, why don't we start with that? How are you dealing with your equity infrastructure marketing with Driftwood Holdings? Walk us through that, and then I want to see how it winds up impacting the cost there.
So the principle is that today the natural gas business on a global basis is becoming a real commodity business. And in that case, if it's a commodity business, you need to be the low-cost provider. The United States is blessed with a few things. First is we have very, very cheap gas in the country from the Marcellus and the Utica, which is dry gas, and then all the associated plays such as the Permian Basin and the Scoop Stack and the Bakken. So in general today in the United States, any gas that is consumed in the U.S. is going to cost at the wellhead $1.50 or less. The issue is to bring it to where it's needed. And the country has been wired to take the gas from the field to the major population centers, New York and the Northeast, Chicago in the Midwest, or California. And now we need to get it to the coastline in order to be able to put it on ships and move it to the rest of the world. Or in the case of Mexico, get it down to the Mexican border. So with that, we have to create a new type of infrastructure. So we need to build pipelines, we need to access the reserves where they are, and we need to make sure that we can prevail ourselves of the price at the wellhead, not at an inflated price that various players along the chain have added to the cost of finding the gas. So we think with our new business model, by inviting partners from around the world to participate with us, they can have the low-cost gas, the low-cost infrastructure, and the low-cost liquefaction, and get gas on the water in the United States for $3 an MMBTU. Of course, they have to make an investment for that.
Right. So basically, you get $1.5 billion investment is going to get you 1 million tons of LNG per year at cost, which is that $3 number. Does that number increase in any way?
Yes.
If you wind up paying more to build that infrastructure?
Yes, I think the major cost increase will be on actually drilling the wells for the 20 or 30 years that the project will be live. Because the most expensive part will be when you're drilling your wells, you're using steel, and that steel will cost you for 20 or 30 years. So we could see an increase to the $3 number.
Does it also slow down any kind of expansion that you're thinking about?
No, I don't think so, because we do have a tremendous advantage compared to the rest of the world in terms of the cost of our gas and our ability to build infrastructure very quickly compared to the rest of the world. It still takes years and do it very efficiently. So compared to anything like Canada, Australia, or East Africa, or anywhere that you find major gas reserves today, our cost picture is significantly better.
So even if you say increase that cost picture is $3, maybe it's $3.50, et cetera, how?
It won't be $3.50, it'll be less than that, maybe $3.25, $3.30.
So what kind of margins are we looking at for that?
We're still looking at very attractive margins.
For a global look, how's growth? Global growth, and how is that impacting LNG?
Okay, so there's two things that have happened. One is we have more gas than we know what we do to do with in the United States. There is, in the next 5 years, a need to find a use for 20 BCF a day, which is enormous, and we won't. So the alternative is somebody has to flare it, which is not acceptable. So we're now all going around in circles saying we have a real problem of excess gas that we don't know what to do with. So that is very good for the United States if you export it. If you keep it here, it's a problem. And the second thing is, on a global basis, it became very apparent in the last 2 years that there is a tremendous amount of price sensitivity. So when we had low prices in 2015, 16, and very early in 2017, demand increased dramatically where it had been flat for the previous 5 years. So with this increase in demand, all the so-called excess capacity that was on the market got absorbed very quickly. China, India, the Middle East, even Europe increased their demand dramatically when prices became affordable.
And that was a surprise, because all we heard was going to have this huge LNG surplus, but it became very difficult to measure demand. And you're laughing because he was the one who was like, no, demand's really strong, listen to me. So there is a lot of gas, yet you're still looking to expand. There's been some analysts saying that you could be interested in buying southwestern Fayetteville assets. Can you give any comment on that?
Well, I don't want to be specific, but we've indicated that we want to buy some upstream assets because that's the way to continue to reduce your costs. So it's certainly one project that we would look at, but it's not the only one. And we've reviewed a bunch of projects, mostly as close to the facility as we can. So the most attractive things that we're looking at today are either in the Haynesville or to find a way to work with the Permian Basin producers to take the gas that they don't need, which is why we've announced also that we will build a pipeline all the way to the Waha hub to be able to help the Permian Basin producers to get rid of the gas that they're not going to need so that they don't have to flare it.
But you wouldn't be buying assets in the Permian. You would just be a contractor to break.
I don't think so, not at least in the first phase. I think we're concentrated right now on the Haynesville as our primary target to acquire assets. And there's plenty of assets there. It's a very attractive basin. And it happens to be 150 miles from our facility, so it makes a lot more sense for us from a transportation standpoint.
And before I let you go, the big conversation at CERAWeek is going to be all about U.S. producers and about what's happening with OPEC. And you've had meetings with Saudi Aramco potentially taking a stake in Tellurian or agreeing to buy fuel in the future. Can you give us any update on that?
Well, I don't want to isolate Saudi Aramco. We talked to everybody. We started with a group of 120 potential partners. Saudi Aramco was clearly one of them. There is nothing special happening with Saudi Aramco compared to all the other people we're talking to around the world. We launched our marketing effort only 3 weeks ago, so we're in the very early stages, but we're very encouraged with the reaction so far. So it'll end up being a group of 5 or 6 potential buyers that are going to be from all different walks of life. There'll be some utilities, there'll be some majors, there will be some traders. It's an attractive transaction. The success will be if we are the low-cost provider. It's as simple as this. It's a binary result. If we're low-cost, we'll be very successful. If we're not low-cost, somebody will have to show me what number I have to beat.